So tell us a little bit about DFA and why we have partnered with DFA and we invest our client portfolios.
Well, you have to be careful about your choice of words. There really is no partnership here. In fact, there's no contract
there is no
between
contract.
Dimensional and us.
When I say partnership, it means really in terms of academic and research, that's it. No, there are no dollars going back and forth.
There's no payments between us and Dimensional. In fact, one of the hallmarks of our firm, and should be the hallmark of all registered investment advisors, is that we're fiduciaries.
Yes.
So we have a duty to do what's in the best interest of the client, even if it goes against our interest. Also, we keep this as pure as possible by only accepting compensation from our clients. So clients don't have to worry that we're selecting some investment because they're paying us a load or a 12B1 fee or some form of payment. So that has nothing to do with it. What it really has to do with is a very thorough analysis of investors' choices, where they could put their money. And I like to simplify this a little bit by saying, let's take all the universe of investment choices out there. Well, we now have learned that anything that's actively managed, basically it's a manager making a forecast and then making a bet on that forecast. That's how you should think about active management. Now, another way to think about them is they're trying to earn some excess return over some appropriate benchmark, right? So anything that's actively managed gets off the table. We just get rid of that. So that leaves very few companies left to analyze that are in the passive investment business. The largest of which and the most famous would be Vanguard. Then you have BlackRock's iShares product line. But you also have State Street. Go ahead.
But even Vanguard and BlackRock, they do some part of active management and hedge funds, and they're not pure.
This is the crazy thing is that the executives of these companies who are offering these passive products, it's shocking to me that if they really understand why they offer the passive, why are they offering the active?
Exactly.
I think the short answer is they make a lot more money on the active products. And I've proposed to Vanguard, I've proposed just about every active manager. In fact, I proposed to the SEC that we should not even have active managers. They're basically wasting the money and the time of investors, and the academic research is very clear now that there is no hope that an investor will determine in advance who will generate alpha in the future. And the short reason that is that we've determined that all that alpha is just a matter of luck. And nobody knows who's going to be the lucky winner. So to get back to Dimensional, when you get rid of all the active choices and you're left with just passive, then it's a question of analyzing what indexes they are tracking. Thanks to Fama and French and several other academic researchers, we now know that there are characteristics of firms. Dimensional Fund Advisors gets their name from the fact that they think of these as dimensions of the markets. Size dimension, a value dimension, a profitability dimension. And each one of these, you can rank companies by the largest size to the smallest size, by high profitability to low profitability, to high book to market to low book to market on a value scale. And so by carving up the market into these dimensions, academics have been able to go through history, primarily using the Center for Research and Security Prices at the University of Chicago, Booth School of Business, by the way. They can look at this data over long periods of time, going all the way back to 1928, and they can develop these correlations between company characteristics and the returns that were earned on those securities over that period of time. that is known as asset pricing model, and it's one of the reasons that Eugene Fama earned his Nobel Prize in 2013, the other being that the efficient market hypothesis, which is basically all information is embedded in prices. But through the two of those concepts, you can say, I want to be passive because prices are fair. And then secondly, among equities, I want to own more value, or I want to own more small, or I want to own more profitability, because as I look at history, I've seen that there's greater returns there. So now I want to look at the indexes available, and I want to look at indexes that have stronger tilts to these dimensions of returns that have correlated with returns in the past. And that's what dimensional has done that's so unique, is they've created their own indexes. They don't go license indexes from other third parties. They create them in-house, and then they manage their funds based on those indexes.
And that is the key difference.
It is the primary difference.
Primary difference.
When you're looking among passive firms, the primary determinant of the return differences are the factor exposures. Now, Vanguard would like you to think the primary difference is just the fees. Fees are certainly important, but they're not the only determinant. And we've looked at funds where one fund is 7 basis points, another one's 50 basis points. And even the 50 basis point fund over 19, 20 years would earn as much as 100 basis points higher returns.
And we have the chart on our website.
Well, you mean on our app?
Yes, on our app.
The new
app.
Right here, you just pull it up. In fact, I want to show you can just go to favorite charts right here, and then you can scroll down, and there's a nice little chart here. It's a dimensional versus Vanguard chart that makes this very point that there's a difference in two small value index funds. This was one of my early revelations. I was reading a book by Charles Ellis where he was talking about there's a new firm coming out with new small and value funds. What is that? It turned out it was dimensional funds. That book was written in 1985, by the way. 1985. Wow. In fact, I call that my $30 million book because I didn't read it literally the day that I received my money. And had I read it, I probably would have ended up with a lot more money. Anyway.
And these factors like small value and profitability, they come to existence like once in 10 years? Or
well, Venkat, you're hitting on another very confusing concept for investors. And it's why I wrote step 8 in my book, entitled it Risk Ease. There is a language of risk that you must know and must comprehend, and you must have a good understanding of. Otherwise, you will be constantly confused by what's going on in really any chance game. I was just learning the game Catan. It's a board game, and it's based on the dice roll, and it's based on the probabilities of what you're going to roll on the dice, with the most likely outcome of 2 dice being 7. Investors have to understand probability distributions. And what you're getting at is we expect to get a certain premium for owning small cap stocks. In fact, we can, again, go to this app. I wanted to look this up. We can look at this chart called the dimension of returns. And on this chart, since 1928, small companies versus large companies have had a difference in return of 2.29%.
That is the premium.
That's the excess return we expect for owning these riskier securities in small cap. But, so 2.29 is the center of a probability distribution of future outcomes. But just like we show you in the random walker or the Galton board, as those expected returns leave the center, there is lots of room for them to bounce to the left or bounce to the right in the distribution of this bell curve. And what you have to do is collect a very large sample of these expected returns for you to expect to get that average. And as you say, you could go 10 years and not recognize this premium that you would expect to hold those factors,
And
or even longer, for that matter.
That's what has happened over the last 10 years. The value and the small cap premium has not paid out.
Yeah, I don't know if both of them are there, but it's so this is the other issue. So it could be even with equities. You know, we have long periods where equities had negative returns, especially in the Great Depression, relative to just T-bills. So then you wonder, well, gosh, should I be owning equities? You have to understand this probability distribution, and a good way to understand it is to look at the distribution of historic returns of indexes. We have 90 years now, and it helps you understand the range of possible outcomes based on 90 or 50 years worth of previous outcomes. It's a range of returns.
And that is expected, because this is not a Ponzi scheme where you get a constant return every year.
Yeah, as Madoff, gave you 1% every month. That's very suspect, obviously.